G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from AllenWargent Property Buyers. I'm here, as I am every week, with Chris Bates from the Alcove Mortgage Specialists. Chris, how's your week been?
It's been wet, if I'm honest. I don't know how we snuck in a game of futsal last night. It was between storms. I was like, this is definitely going to be called off, and somehow we got to play. But yeah, it's been very wet here in Sydney. A big flood to the north coast. We were meant to be going a massive hike up near Nelson Bay this weekend, and we're dumping the kids at my mum's for 2 nights, and we're going to do this big hike. But we're not sure if we're going to go now. It was 28k hike, the Tomaree track or something. I'm not sure if it's going to be too wet, but other than that, kids' birthdays last week. Just took photos of those mushroom photos into ChatGPT, as you do nowadays, and found out one was highly deadly, and my boy actually touched that one with his hand. So that was our weekend last week. What's been happening with you, Pete? You were in Bali, now you're over in the UK. What's happening?
Oh, mate, you've just reminded me. There's a place where we stay in England, very close to where we live, where there's like the psychedelic mushrooms grow. But I'm just like, I would be 100% guaranteed to be the person who picked up the wrong one and ended up in the news. So yeah, I'm always too scared to go near anything like that. But yeah, I was in Bali when we spoke a week ago. We also got some rain, but just landed in England today. So just been watching the Spurs Europa League final, so lots of happy Londoners around the place, and yeah, I guess Spurs get to go into the Champions League next season, so we'll be seeing you guys there. I don't know if we fully deserve it, to be honest, finishing 17th, but yeah, good to see an Aussie manager get a win over there.
Yeah, I think that's actually the key story here. An Aussie manager winning in Europe. That's a big success story. But if he lost, I think the story would be that, they finished 18th or 17th, can't be 18th, but at least 17th in the league. And he's probably getting the sack. So 90 minutes of football was a bit of a change in direction of his career. Let's flip it off football to, another big story this week. The rate cut happened, Pete. It was expected, but the RBA comments and the dovish sort of storyline through it was not expected. And I think it's a pretty big shift. I'm going to do a post today on LinkedIn. I'm going to steal a line from an AFR article, if I'm honest. And in that line, it said, it seemed like a victory lap on the war on inflation. I thought it was a really good line because, it did feel like that when you were reading the comments. What did you think, Pete?
Oh, completely. I must admit, I got it completely wrong. I was actually on social media because NAB was talking about a 50 basis points this week. And I said, they must be smoking something, thinking about 50. And as it turned out, one of the first things they noted in the press conference was that they discussed a 50 basis points cut or 25. 25 was what markets were pricing for. So the cut was expected, but the dovish nature of the rhetoric and the press conference wasn't. And you could actually see that the Aussie dollar dropped straight away. The 3-year bond yield fell about 18 basis points. So obviously the commentary was much more dovish than expected. I think inflation, the headline rate of inflation, might just jump back up above 3% at some point. It just happened in the UK this week as energy subsidies are unwound. But if you look at the core rate of inflation all the way through to June 2027, the forecasts are for 2.6%. So basically the victory lap, as you said. And I think the implications are we've still got a restrictive cash rate setting, and therefore it would make sense that gets taken down to a neutral level, which is somewhere between 3 and 3.5. So that sort of implies maybe 2 more cuts this year. So yeah, I was surprised by it. I thought they might be much more cautious, but as Michelle Bullock said, it's a confident cut. So and they were even talking about some downside risk scenarios, and therefore whether or not they should just go hard with a 50. I think it was always going to be 25 basis points was my reading of it. But yeah, I think the press conference was just a little bit more dovish than I would have thought.
I thought it was interesting to distance herself away from, the implication of rate cuts, which may cause a property boom. And that's not her responsibility. That's the local and state governments. They've got to sort it out with supply. I thought that was interesting that, they really, because that's likely what's going to happen. I want to know why NAB are so bullish on how many cuts. They're saying 2.6% by Christmas, basically, right? Or Q1 next year, where a lot of other economists are sort of sitting, probably playing it safe, if I'm honest, groupthink, are sitting in the sort of low threes and to mid threes. So they're way out of the market, and I wonder why they are so optimistic on so many rate cuts. I mean, that's usually because they're so pessimistic on our short term, employment numbers and our growth coming. So. But that's one of our challenges, right? Our unemployment market's still really steady and holding up. Are we going to get that dream landing, Pete, do you think?
I think yes, I was going to say the same thing. I think NAB's view is probably that although the tariffs turmoil has kind of been put on pause for 90 days, at some point that could come back around and we get all of the sort of implications for international trade. And therefore, it wouldn't make sense to have a neutral cash rate setting in that situation. We'd have to go down to the mid twos. So, yeah, I mean, it moves around a lot. I mean, things have changed a lot in the past month or two. But I think as we actually got the jobs figures out this week, and big upside surprise there, 80 odd thousand jobs. I think sometimes you need to look through the monthly noise. If you sort of average the last 3 months, it's about 25,000 a month. So it's fairly steady, but unemployment rate still 4.1%. So yeah, I think there's lots to be optimistic about for Australia. The forecast that the Reserve Bank put out suggests GDP growth of fairly sluggish, just over 2% over the next year or two. Unemployment rate just ticking up, but not that much. So I suppose there's a bit of firepower in the tank there if it's needed to cut interest rates further. I think on the dual mandate question, it's an interesting point because the media often goes for this angle of, why is the Reserve Bank doing X, Y, Z with interest rates because of what about the implications on the housing market? Well, they've already got a dual mandate. They don't need a third thing in the mix. This goes back to the Glenn Stevens days and a lot of those discussions about whether central banks should lean into the wind on asset prices. And I think it's, to be honest, it's not really the job of the central bank. One of the ways in which lower interest rates work on the economy is through boosting construction. So we've seen higher interest rates over the past 18 months. It's really slowed down the rate of home building. That's just one of the mechanisms via which monetary policy works. I don't think central banks should start targeting housing prices because then, they would have way too many competing interests, and it would just complicate the task and accountability of the RBA.
And I think monetary policy also has a huge impact on whether it's the wealth effect, but also just exchange rates, right? And exchange rates have a huge impact on the economy, not so much that's often misunderstood. I mean, what's your thought? We've seen a little bit of this return to work articles this week. I mean, NAB said get back to the office 5 days, and then I've read another article which sort of goes against that and says maybe it's running out of steam and hasn't really been growing over the last few quarters, and we're maybe about 80% of where we were pre-COVID. Melbourne's still very much enjoying the Monday and Fridays and the long weekends at home. But what's your sort of take on that, Pete?
Well, I saw in the Fin review this week, it was reported that Westpac is going to cut 1,500 jobs across a number of divisions, so banking operations, procurement. And I think, especially in Australia, because we have this kind of oligopoly system, the big four banks, if one of the majors is doing something, you can be fairly sure that other banks are at least thinking about it. So I think that's fairly significant. And I think that there's a lot of disruption going on across banking at the moment in terms of AI and different ways in which they might look to boost productivity. As you said, National Australia Bank is really keen on getting people back into the office 5 days a week. And I think at the moment, the balance of power has been very much in favour of employers. If the unemployment rate's 4% or about, they've got the upper hand. But if we're moving into the realm of redundancies and rising unemployment, or maybe there's a bit more leverage there for employers to get people back in the office at least 3 or 4 days. But I think there's some sort of sundry implications for the housing market as well, with artificial intelligence and AI agents, and even on the media and reporting side of things, use ChatGPT or Grok to help with finding stats and so on. That side of things is only going to keep on accelerating, I think.
Look, I think we're doing this every week, Pete, and hopefully I'm still doing this for an extra 20 years with you. But I think we like to follow certain stories. We just talked about, the flexible work, we sort of the move to the regions. And, I think this is the story I think it's going to be of 2025. I mean, I've been watching this probably for 10, 15 years. The tech shifts are particularly around what I do for work, right? Around fintech when I was an advisor and prop tech, and been watching all these platforms and personal financial management tools, and, all the rise of open banking tools. And a lot of it was, good marketing, and the theory's good, but it never really got past the early adopter stage, right? It didn't become mass market. People just didn't really embrace these things. And I feel like maybe we're there. Maybe this AI experience is bloody good. It's the worst it's ever been. And, and a lot of people say, oh, it's all hyped up, but I actually, it's starting to now, but I think maybe actually it's underhyped. And I think we're just going to have to really track this story, because the implications on, this scenario playing out much faster than people expect is going to have huge impacts on, employment, wage growth, productivity. And it's a story we're probably going to have to really track, because it's changing so fast that no one can really predict where it's going. And, I think it can have huge implications on the Australian economy and the global world. So let's just keep tracking it. If there's anyone listening to this that, is real true experts in this space, which is hard to be an expert of something that's moving so fast. You think you got the knowledge, but then, obviously it's running faster than you. And maybe it's going to be smarter than you anyway in, a year or two, if the general intelligence is where we're heading. But I think this is the story we need to track a bit more, Pete. I think it's going to have how it plays out could really have huge impacts on lots of different things.
I think it was a Hemingway quote, wasn't it? Slowly at first, then all at once. And I think that can apply to a lot of things. Like I was telling to an old economist friend, and he was saying how his bits and pieces of his body are stopping working. I think it was the same with the working from home shift. It was something we talked about for years, this general trend towards people working from home. And then COVID happened, bang, and everyone was working from home. And maybe that's the way things will go with AI. It's kind of crept up on us over a number of years. And, we've seen the tools that are kind of like word calculators, and it's quite clever scraping for data and so on. But as that starts to improve and accelerate, the impacts across financial services, a lot of the services economy could be dramatic. So, definitely one we should track over the coming weeks and months. I just wanted, before we do the three big news stories of the week, Chris, I saw in ABC News, they said 24 lenders have cut their fixed rates ahead of the Reserve Bank decision. Are you starting to see some interest rates in the fours now for people borrowing, or are you still a bit higher than that generally?
Oh, I don't think there's any fixed rates in the four. There wouldn't be any variable rates in the four.
No, definitely not variable. I think the article said that we're starting to see interest rates fall into the fours. So it's a bit hazy, a bit sketchy. I'll put a link in the notes anyway.
Maybe I haven't, because I think there's a mental thing. I was actually chatting to a couple of chaps at the office about this earlier in the week, and we sort of said, well, if the RBA can get down closer to sort of low threes, just given the competition in the mortgage market and broking, has been a contributor to that over many years. And net interest margin on loans is getting, maybe 1.6, 1.7%. So if we get an RBA rate at 3.3, we could get a variable rate under 5, and that's likely with some competition. We are, I haven't wanted to call it too early, but I reckon now is probably the time to say that I think bank pricing and the bank war is happening, but it's not happening on the front pages. It's happening in the back streets here. And what I mean by that is that it's happening when you're leaving banks. So when you're sending a discharge form in and saying, right, I'm buggering off, I'm going to another bank, they're coming in with some ridiculous retention pricing, way better than we're getting for new customers. And so that's not out there, right? So, unless you're really fighting your bank and putting a discharge in, they're not coming up with these deals. But what it shows me is that they're willing to, compete for you as a customer and eat into their margin to retain you. I don't think it's too much of a stretch when they start offering those to new customers, and then all of a sudden it's a full-blown war again. And so we have seen a few different banks undercut each other with new pricing for customers as well, which we haven't seen too much over the last couple of years. And so, if there's this rate cut plus a little bit of a mortgage war behind the scenes, you could easily see, variable rates maybe get under 5 if there's a couple more cuts. And so that's a psychological barrier that may actually also give a lot of buyers a lot more confidence.
It would make sense if the Reserve Bank sees the neutral cash rate target at, say, 3.25 or somewhere like that, between 3 and 3.5. Well, yes, it would make sense that the neutral kind of mortgage rate might be around 5. And also just that psychological aspect of a mortgage rate with a 4 in front of it sounds a hell of a lot different from something with a 5 or a 6. So, yeah, let's take a look at the big 3 news stories of the week then. So we do this every Sunday morning on the 2 cent segment of the Australian Property Podcast. So first story this week from Chris Joye in the Australian Financial Review. All ingredients are in place for an enduring housing recovery. So I'll just bullet point his main talking points there. So essentially forecasting housing prices to increase by about 10%. And I think some of the factors we've already touched on, inflation is effectively being slain. We've got some rate cuts coming. That in turn increases borrowing capacity. I think the Federal Reserve in the US is expected to sort of mechanically or methodically, I suppose, reduce the funds rate over there to somewhere in the 3s over the next year or so. And Australia will probably follow in that trajectory. And I think we've got brisk population growth that Chris mentions in the article and inert supply. I think we're definitely seeing that. I think we, just as an anecdote, we were tracking a property in Brisbane this week in Alderley, nice property, just on a small block, 31 offers, and the offer they bought there wasn't even the highest. So I think, yes, it's really tough if you're at the lower end of the market and you're kind of locked out by tight lending standards. But there's a lot of people in that sort of aspirational home buying market, and we're just not building anything like enough across southeast Queensland, and I'm sure that's being replicated across other parts of the country. Chris, I know you've followed Chris Joye's commentary and articles over the years. Did you get to take a look at this one?
I did, and there's not many people I'll religiously read as much as Chris. And that's not be arrogant. I just rate his stuff, very highly. I was surprised he went a bit quiet, if I'm honest, when he got it wrong a little bit. But he wasn't the only one got it wrong. Everyone got it wrong. Everyone got the relationship between borrowing capacity and prices. Is that correlation's been really strong. And, Chris rightly pointed out, when borrowing capacities collapsed because the RBA rate shot through the roof, you would have expected a much bigger decline in prices. But, the property market stayed very resilient. Everyone started banding that word around for a couple of years there. It's resilient. Well, yeah, because the market froze up. I do think it's still frozen. We've had a few clients buy in the West this week, 3-ish million, been looking for a while. And but it's 22nd of May, it's getting close to June now. Listings are going to dry up. You're going to not too long away before we get to those next school break, at the start of sort of July, end of June. And, agents aren't going to want to list it. Obviously, agents always go away. Whether they go overseas or not, probably not this year because, they haven't really been getting the transactions that they need to fund those European holidays. And so I wonder if they're going to either work through or maybe start listing in July. But, if we do get another rate cut in July, I think those together with the one we just had, could set us up for a lot more demand in the second half of this year. And that's kind of what Chris is basically saying, is that, confidence is returning, borrowing capacity is going up, and he expects, circa 10% this year. A lot of there's a bunch of economists that are basically saying, it's not going to be anywhere near that. It's not going to run out. It's not going to have that steam. But I think what will happen is when FOMO kicks in a market, is that even if it's unaffordable, you go, I need to buy something, and so I can't afford something at $1 million, but I can borrow at 900. Well, if I don't buy 900, I'm not going to be able to buy it all. And so you go and push an $800,000 property up to 900 because your 900 gets pushed up to $1 million. I think so. I think the property market's still got a lot of steam because a lot of people will make a lot more compromises when there's this FOMO kicks in. Do you sort of agree with that, Pete, or disagree?
I think so. Yeah, I think I was also surprised when interest rates went up that the housing market still had a lot of momentum in cities like Perth and Adelaide. And it didn't really seem to have that much impact at all. I think a lot of discussion was had at the time about the Tulip and Saunders model, which I guess if it's an old sort of RBA research paper that talks about a 1% change in interest rates impacting housing prices by up to 28%. And you would therefore say, well, if the cash rate's gone from 0 to 4.3, how come prices haven't fallen so much? But I think there's a little bit more to it than that. There's a bit more nuance. One is that you're talking about changes in the real rate, the real interest rate, not the nominal interest rate. So you've got to factor in inflation. But also, I think the closer you get to the zero lower bound, the impacts might not be the same. So, for example, if you take the cash rate from 0.1 to 0.5, yeah, it's a big hike, but it actually probably doesn't change housing prices that much. So I think that was a factor. I think the other thing is we just had such a shortage of housing and a mad boom in population growth. So
yeah,
I think
absolutely.
sometimes, this is one of the challenges for AI is that, you can sort of forecast things based on what's happened before, but we don't have any sort of previous episodes of border closures and then 500,000 people roaring back into the country in a short space of time. There's nothing we can look at in a previous cycle to say, well, this is how it's going to play out. So sometimes, I actually sort of read Scott Sumner this week talking about AI and macroeconomics, and AI can be really good at computations, but then sometimes there's sometimes there's sort of more nuances, and definitely in the housing market, I think it's more of an art than it is a science sometimes in terms of which properties are going to perform and which suburbs and which trends you're seeing. It can't just be fed into a computer. So yeah, I was surprised as well. But I think if we get a couple more rate cuts this year, maybe a bit of competition between lenders, I would definitely expect to see prices higher just because we're not building enough. And I think the confidence is really what drives the turning point in the cycle.
Yeah, absolutely. I think let's crack on with story number 2, Pete. We're getting some good flow going on here.
So yeah, I saw an article in Yahoo this week, the pros and cons of moving to regional Australia, and the article was essentially saying that with the cost of living crisis, especially in the rental markets, a lot of Aussies have chosen to move regionally over the past year or two. Sunshine Coast, we've definitely seen plenty of that. Places like Toowoomba, Southern Highlands in New South Wales, or Albany or Bunbury in WA. So I think you can definitely save on rents, and also to a certain extent on things like groceries and eating out. Definitely get more space for your money, more bang for your buck. I suppose sometimes if you go regionally, it depends on what you do for work. You may not have the same earning capacity. So there can be a sort of a cheaper cost of living, but it depends what you're doing for your work. I suppose if you're running a business that can be done remotely, there's definitely a potential benefit. And I suppose it's just a different lifestyle more generally. I loved living in the middle of Sydney or in the eastern suburbs when I was younger, but different stage of life, I suppose. I quite like the regional lifestyle of Noosa these days. It's a little bit less hectic. You get a bit more space, and it's you can drive down to the beach and not have to fight other people for parking. So there's definitely pros and cons. Do you think this is just an ongoing trend for younger Aussies now, or do you think it's more of a cyclical issue?
Oh, look, I think people want security and stability for them and their families. And, from an affordability point of view, they're having to make compromises. And yes, there's a lifestyle tree change, getting out of the city. But, I do think that, you would do that when you've got real good confidence, great English, but good confidence that basically that, your employment prospects are going to be really high. All right. And, you're going to be able to still earn a good income and have the career trajectory. And you're not going to have to be out of the workforce. And, because you've got to always be concerned that you're taking, too many risks with your job as well. And so I don't know. Yeah, the unemployment rate's low, but, there's a lot of pressure on productivity. There's a lot of people getting back to the office. Maybe this AI, do you really want to get out? Or do you want to really try to protect yourself and double down, right? And moving away and further away from the capital city feels a little bit unsafe right now versus in COVID when there's a talent shortage and, no matter where in the world I'm living, you're going to need me. And I just a little bit concerned about that because if that happens and you do move there and your job prospects aren't there, do you have to then get back to the city and then you get priced out because it maybe runs harder because everyone's buying around the city? And so, I wonder if it's going to maintain the momentum I think it has definitely slowed down, particularly the sister cities to the capital cities in the last few years. We've had a lot less clients buying Central Coast, north of Wollongong, the Mornington Peninsula, Geelongs than we were in the last few years, and probably similar to what we saw pre-COVID is happening now.
I think the housing cycle is actually a massive driver of interstate migration. If you track it back over the decades, I think there's been various periods where the price of a house in Sydney is, say, 2 times or twice, following you with the bad English. Now, I think at one stage it was like 2.2 times as expensive as buying in Brisbane for an equivalent house. And therefore people are like, well, hang on, if I can buy something so much more cheaply in southeast Queensland, we should make the move. And obviously Sydney to southeast Queensland is one of the biggest population flows that we get internally in Australia. But that sort of price differential isn't there at the moment. I think a lot of regional markets are much more expensive than they were in 2020. About 59% of net city outflows are accounted for by Sydney-siders moving out. According to the Yahoo article, that is down from 65% in 2023. Melburnians are increasingly on the move, with their migration up to 40% compared to the prior year. I think, though, if you look on a net basis, though, Victoria isn't losing people anymore. It did during the pandemic, but a lot of people have drifted back to Melbourne. And of course, we talked about last week, the population of Melbourne is set to boom to 9 million by mid-century. So, I think it's traditionally people move out of Sydney. I think migrants go to Sydney and Melbourne. And then internally, we tend to move out to the coastal markets. But I think it is slowing down a bit. I think it's just not as cheap. It can be a no-brainer if you find a really cheap market to move to regionally, but it just doesn't seem to be the case at the moment.
Yeah, and I mean, the articles that when you read these articles, you've got to look at the case studies, right? So one case study is a teacher. You probably can get work wherever in the country. It makes sense to live regionally, right? Trying to, if your salary doesn't get hit that much and, the cost of living is much cheaper, then it sounds like a better life if you're willing to let go of some of the lifestyle benefits of living near the city. But someone who loves the country, I reckon the lifestyle benefits there are pretty good when you get to a stage of life. And the other one is Tash, who's got podcasts. She's an influencer. The Rask community knows her as well. Her pitch is affordability, is basically saving and being money wise, right? And so it's good for her because she can save, but if influencer can work anywhere, right? And so it doesn't mean that. I always like these articles when you read into the stories and go, well, that's not everybody in the marketplace who can afford to do that. What do you reckon? Eliza Owen's third article here is Aussie homes worth $1 million, a third of Aussie homes. What's your take on this, Pete?
I can't remember who I was talking to. I think it was my father-in-law earlier today, and there was a BBC News article about millionaires leaving Britain. But as he pointed out, a millionaire, it used to mean something, didn't it? It used to be like a millionaire was somebody you'd be scared to talk to. They was super wealthy, but actually these days, an average household, if they buy a home and build up a bit of a pension pot, they become millionaires. So. Yes, and I suppose housing prices are a function or a part of that. So, yes, Cotality, Eliza Owen, prices are up 67% over the past 10 years in Australia. So, back a decade ago, only about 10% of properties were priced at 1 million or above. Now it's 34%, or over a third. The capital cities have gone from 14% to 42% above a million. And the regions, now about 20% of properties are over $1 million. Certainly a lot more on the Sunshine Coast, that's for sure. The median value for houses is now above 1 million nationally, and 5-bedroom houses above 2 million. So a couple of forecasts in there. Brisbane is going to go over 1 million median very soon because it's right on the cusp of it. Hobart has slowed down. I think another interesting factoid here is that 70% of the housing value in the market, so 10.6 trillion, is in the land. So Cameron Cusher pointed out this week. So I think a lot of these articles are sort of they spawn a whole sort of surge of articles about nobody will afford a house. But I mean, 67% over 10 years, it's not really that dissimilar to the rates of growth we've seen previously. Had lower inflation, of course, in recent decades. And even still, I've seen enough case studies of people losing money. People talk about prices going up, but so many people still get into trouble buying off the plan, or just buying at the wrong time, or buying the wrong property. So although there's a housing escalator and prices have kept on going up, it's not just one-way traffic either. And sometimes people do get caught out even still.
I think that's right. The key point here is, let's say the total dwelling and land value, say circa 10 trillion, or maybe even higher than that. I think that 10.6 trillion, right? But 70% of that's in the land, 30% in the dwelling. But the dwelling has actually gone up a lot. It's pretty steady, inflation-like, cost of dwelling. And then in the last few years, it's absolutely taken off. And so, land prices have been going up, but also the cost to build. So then that means the value of our replacing our current dwellings is gone up as well. And so that's been a bit of a surprise. If you looked at the dwelling, value, it's been a pretty slow, steady growth. This is really out of kilter over the last few years, and it kind of really shows just how much the cost to build has impacted prices.
Definitely. I think Cameron put together an article, or a chart actually, of GDP in Australia and the value of total value of land and buildings. And I think, I suppose if you plot those two variables, the GDP goes up very slowly. And of course, as the population grows, housing values go up quite a lot. And it looks like the lines are diverging. I think the best way to look at that is as a ratio of GDP, and particularly nominal GDP. And I think it's about 4 times. Our GDP is just over 2.5 trillion, probably heading to 3. Value of the housing market is 11. I think at the peak, we were probably at about 5 times GDP, which is very high internationally. But, does this mean a lot? I don't know that it's going to be an indicator for housing markets. I saw previously people were saying if it goes over 3 times GDP, the world's going to end. But then you go to a place like Hong Kong. I remember when it was way high in Hong Kong, so I don't know, there's no single variable that can tell you what's going to happen. We've certainly been higher in the past. There's a ratio to GDP in the sort of recent years. So, I think it's an interesting insight, but I wouldn't be at all surprised if over the next decade we'll get similar rates of growth over 10 years. I wouldn't be at all shocked by that. And even though at the moment we're all talking about housing shortages, I think we'll get another apartment construction boom sometime over the next 5 years, say. So I think we'll see a lot of the same patterns playing out, even though the sort of day-to-day articles always talking about sort of outlier events and booms and crashes and so on. I think over a decade, housing prices have been fairly sort of steady growth, I guess.
Yeah, absolutely. Should we crack on with 2 listener Q&As to wrap us up today, Pete?
Yeah, let's do that. First question from R. So do send in your questions, by the way. We've got plenty to work through, but keep them coming because we always like to cover off some of your key questions or considerations. So question from R. I have a commercial property I use for my business in my self-managed super fund. What happens when the policy changes for taxing unrealized gains? Will it be implemented? Is there anything I can do? Yes, on the first point, will it be implemented? It seems that way. I mean, I suppose to me, the more you look at it, the more taxing unrealized gains is a bit of a madcap idea. And it sort of starts out maybe not impacting that many people, but as asset values increase over time, it could impact a lot more. The main issue is that not all assets are liquid. I think if you've got gains in the ASX or the international stocks or something, well, you can sort of manage that cash flow implication if you've got capital gains by selling off some assets. But if you've got a big illiquid asset like a farm or a medical center, or in particular if you've invested in a venture capital fund where you might have a valuation of 10 or 20 million, but actually you can't sell any of it, well, that's where it could start to get really ugly. So look, in answer to the question, will it be implemented? It looks like that's the direction of travel. Certainly it's going to be put to Parliament and then presumably passed by the Senate. In terms of what you can do, This might be a question for you, Chris. Can you refinance? I think in self-managed superannuation, it may not be as easy if you need to sort of pull out a line of credit. I know if you're doing things outside of super, you can do a refinance relatively more easily. But what would happen in this circumstance if you've got an asset value that increases by, let's say, $1 million, and you've got to come up with the 30% tax? What do you do in that situation? Are you forced to sell, or can you do a refinance?
Look, I think you just got to see how this plays out with the government and do they actually get it through. And there's a lot of efforts to get rid of this policy. And, you know, it makes sense to fight it for a lot of people. And that's whether I agree with it or don't. I think there's a lot of people with huge balances in superannuation, whether 3 mil is the right number, whether it should be higher than that, or there's issues around maybe it not being indexed. And so, you know, it doesn't affect too many people today, but it affects a lot more people down the line. But I mean, it's pretty crazy if you started to tax unrealized gains, because it's really hard to pay for those taxes if you don't sell your assets. And so it's like if you had unrealized gains on property, let's just say you bought an investment property for $1 million and it goes up to 1.5, or what goes up to 1.2 that year. And then the government says, hey, you've got to give us 50 grand. Where are you going to get 50 grand from? You're not going to be able to do it. And then it goes from 1.2, you do pay it, and then it goes from 1.2 to 1.5. They go back, hey, another 75, thanks. We haven't sold the asset yet. So taxing unrealized gains is really hard. You've basically got to keep a lot of money in cash to pay for the gains. And yeah, I mean, this is in super. It's obviously there to encourage people to get money out of super, hence why they're going to do it. I think it's going to be roughly around 25% tax if you've had it more than 12 months as well. So if you've had this property in there for more than 12 months, you probably so. But yeah, it's a big issue. And so, yeah, I just wonder if it's a little bit of a Trojan horse to move into taxing other unrealized gains. Because you imagine if you had a big Bitcoin portfolio, I think A, you got to pay a higher capital gains tax, and B, imagine if that was unrealized. And if as soon as super was Bitcoin balances, you'd have to actually be selling down. And do they move it into other things? I mean, I think property is probably the last one because so much of the Australian wealth's tied up in it. But yeah, it's an interesting one, right, Pete? It's a first step into something that doesn't really make sense from an investment point of view, but it's really going to discourage people to take money out of super. And get some advice from an accountant and a financial planner on this one. It's highly individual and personal, advice you need. So yeah, but hopefully that was helpful.
Yeah, it goes against the principles of taxation in my view. It's a long time since I did my tax exams, but you're not treating gains and losses the same. I see Jeff Wilson is running like a one-man campaign to get this policy scrapped. So I think there's a few question marks about what happens to existing assets if you've already got capital gains. And I suppose you could argue in residential property, we already have land taxes, which act as a sort of a quasi tax on your gains as you go along. But I think one of the unintended consequences here, if you keep tinkering with the superannuation system, then people will stop using it, but they'll just funnel money straight back into the family home or residential property outside of super. And the unintended consequence is just pumping the housing market.
Yeah,
because you're closing off what might have been a loophole, I guess, the superannuation system. But if you start taxing unrealized gains and you keep changing things and there's uncertainty about indexation, well, you're just going to go back to things that you have been more reliable, I suppose. Let's do one more question from Fred Flintstone. Not the actual Fred Flintstone, I don't think. I think it's a pseudonym. But I can get a reasonably good fixed rate mortgage of 5%. Is it worth fixing or not? What are the benefits and what are the cons of fixed rates? And can I fix half of the mortgage? So, Chris, this is right up your alley, this question. I guess most people usually go variable. I think when interest rates were super, super low, fixing made a lot of sense. But now interest rates are on the way down again. So what do you ever get people who sort of look to fix half the mortgage or something like that?
It's funny. A few friends and clients have come off 4-year fixed rates in the last week. And I was at a friend's house on Sunday and he's like, oh, my fixed rate's coming off. my payments are going to jump up. I'm like, mate, you've been on 1.99 for 4 years.
Cry
It's
me a
a
river, yeah.
ridiculous size mortgage that he's got, in fairness. But he's probably 4% saving per year for the last probably 2-3 years. So, let's say an average of maybe 10 to 12 after tax times his mortgage. So he's had a bloody good. So, which I did happily tell him that. And another client emailed me saying I'm one of the fortunate ones who's come off a fixed rate. So absolutely, there's times where it makes a lot of sense to fix, and then there's other times where it's a gamble, and it may work, it may not. And I guess that you can absolutely fix half your mortgage, or even 20 grand. You don't have to fix the full mortgage, and that makes sense. 99% of the time, because you want to have something variable that you can have an offset account in, and you can offset that while you build. Even when clients wanted to fix, a lot of them were fixing 80-90% of their mortgages, because the rates were just so attractive 3-4 years ago. And I don't think you'd be upset if the variable rate went to 1.5% if you're fixed at 2%. But 5% doesn't seem that great. We could be at 5% variable rates by the end of the year. And I guess what you're gambling on there is that maybe there's an inflation runs again, and rates have to go back up. Or if it goes the other way, war on inflation's truly buried, and actually, no, we're struggling now, and our economy needs some more support, and there's more rate cuts, and all of a sudden, bang, you're stuck on a 5% interest rate, and variable rates are 4.5 or 4, and you're going to be like, oh, I wish I didn't fix. And so we've seen that people get caught out. In fairness, if you rewind all the way back to when Donald Trump first got in, was it 2016 or what was it, 18, I think it was, or something like that. Yeah. I remember seeing at the time a 3.99% rate, and thought, bloody hell, that's good. Under 4%, psychological thing. And that ended up being massively wrong. And we had a bunch of clients who fixed, who, when rates collapsed after that, we all went really low. So, yeah, just always, the real risk, though, is if you get caught on a high rate and you want to get out, there's usually going to be a cost to do so. It's something called a break fee. And really what a bank basically says is what's the current rate and what's your mortgage rate, and then extrapolates that out and says, oh well, you're out of the money by 1.5% times your $500,000 mortgage. Well, there's a $7,500 break cost, and that eats into the benefit of getting out, and so then you're gambling on gambling, and that actually gets quite hard to know what to do.
I've never tried to work it out, but I'm pretty sure if I went back over all the years, I don't think I ever made $1 from fixing. I think I did really well during COVID, like a lot of people did, by fixing. But then after the global financial crisis, I had some fixed rates where interest rates were coming down. I saw no benefit at all over that period. So I think you get some certainty. That's what you gain, but you also lose some flexibility. So, yeah, I don't know. It's I think if you think you're going to make a buck doing it, though, my experience, even following the market closely, I don't think I've ever saved anything, really, if I was to work it all out. So let's wrap it up there this week. So, yeah, send in your questions if you've got anything you want us to cover off in the weeks ahead. Always happy to cover those. Chris, what's on for the weekend?
Hopefully we do this hike. If not, we'll probably have a much more boring weekend somewhere away, though. But hopefully rest and recharge and get a couple of nights away from the kids. Sounds like we don't love them, but we do. But wouldn't mind a break. So what about you, Pete?
I've got a business course or a personal development course coming up this weekend. I don't do many of them, but that'll keep me busy, and maybe a bit of gardening. I've got lots of gardening to catch up on because I haven't been to England for months and months. So, yeah, fairly quiet for me, I think. So, yeah, thanks everyone for tuning in, and look forward to seeing you next time.
Chat next week. Thanks, Pete.
Cheers, Chris.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.